This report provides an in-depth financial assessment of British American Tobacco plc (BAT), focusing meticulously on the structural integrity of its cash flow generation, the defensive characteristics of its balance sheet and capital structure, the security of its progressive dividend, and the contextual analysis of its current market valuation. The comprehensive due diligence confirms that BAT operates from a position of profound financial resilience, driven by its predictable and high-quality operating cash flows. The analysis supports the view that BAT presents a compelling high-yield income proposition, currently trading at a significant and historically deep discount relative to its major global sector competitors. A. Introduction to market position and strategic priorities. BAT holds a crucial and diversified position across the global tobacco and nicotine landscape. While maintaining a strong cash-generative portfolio of combustible brands, the company's strategic direction is unequivocally defined by its ambitious pivot toward reduced-risk products, RRPs, or new categories. This strategy, known as Building a Smokeless World, has clear, time-bound objectives. Management is targeting 50 million consumers of its smokeless products by 2030 and aiming for smokeless revenue to constitute at least 50% of total group revenues by 2035. This transformation is financed by the substantial cash flows generated by the declining, yet highly profitable, core business. The current financial strategy prioritizes disciplined capital allocation, specifically through continued deleveraging and maintenance of the progressive dividend policy. Synthesized summary of key financial strengths and risks. The company's investment merits are anchored by the dependability of its core financial metrics. Firstly, cash flow quality is exceptional, evidenced by the net cash generated from operating activities, CFO, consistently achieving a 5-year operating cash conversion track record of 100%, culminating in an outperformance of 101% conversion in 2024. This consistency ensures that free cash flow, FCF, before dividends remained robust, recorded at £7.901 billion in 2024. Secondly, the company's solvency and debt structure has been significantly fortified. Deleveraging efforts successfully met key management targets, placing the adjusted net debt to adjusted EBITDA ratio at 2.44x in 2024. This figure situates the company squarely within its targeted 2.0x to 2.5x leverage corridor. Furthermore, the debt structure itself is notably defensive, benefiting from a long average maturity approaching 10 years and a high percentage, 78%, of fixed-rate debt, insulating the balance sheet from interest rate volatility. However, the investment thesis is subject to material regulatory and litigation risk. The most significant near-term financial outflow is the required £2.6 billion upfront payment related to the Canadian litigation settlement anticipated in the second half of 2025. This payment, while large, has been largely pre-funded by strategic asset sales, minimizing the impact on core FCF and deleveraging momentum. A second major risk is the persistent valuation discount relative to peers. Despite its operational stability and confirmed strategic progress, BAT's latest 12 months LTM enterprise value to EBITDA, EV to EBITDA multiple of 9.6x, 5 lags severely behind key international competitors, such as Philip Morris International, 15.9x. Anchor points for valuation: the potential for re-rating. The substantial valuation gap is a persistent market penalty, primarily reflecting the inherent regulatory pressures and investor uncertainty regarding execution success in high-stakes markets, particularly the U.S. NGP segment. Crucially, the evidence of successful transformation demonstrated by the NGP portfolio reaching 17.5% of group revenue in 2024-9 and the achievement of financial deleveraging targets should act as powerful catalysts for future multiple expansion. The current substantial dividend yield acts as a core compensation mechanism for investors waiting for this anticipated re-rating. Deep dive into cash flow statement analysis. The quality and consistency of cash flows are the central pillars supporting BAT's credit profile and its commitment to shareholders. A detailed examination of the cash flow statement demonstrates a stable operating engine despite the secular decline in combustible volumes. The operating engine trend analysis 2020 to 2024. Net cash generated from operating activities, CFO, has exhibited remarkable resilience and consistency over the observed 5-year period. This stability is fundamental to the company's classification within the defensive consumer sector. Quantitatively, the annual CFO has remained tightly consolidated around the $10 billion level. In 2020, CFO stood at $9.79 billion, dipping marginally to $9.72 billion in 2021. It then recovered to $10.39 billion in 2022, achieved a recent peak of $10.71 billion in 2023, and concluded 2024 at a highly robust $10.13 billion. This pattern of consistency, demonstrated by the tight range of $9.72 billion to $10.71 billion across 5 years, indicates that BAT possesses significant operational leverage, allowing it to effectively utilize pricing power, brand recognition, and consumer loyalty, particularly within its highly profitable traditional combustible business. This sustained operational stability creates an extremely predictable financial foundation for strategic planning, capital return programs, and debt service. Further confirming the high quality of earnings is the company's documented cash conversion performance. BAT has maintained a historical delivery of 100% operating cash conversion over the last 5 years, specifically achieving 101% conversion in 2024. This figure substantially exceeds management's internal minimum target of 90% conversion, illustrating exceptional efficiency in managing working capital and translating reported earnings into tangible cash resources. Free cash flow dynamics and investment profile. Free cash flow, FCF, represents the critical resource available for debt reduction, shareholder returns, and discretionary growth investment. The tobacco industry model is intrinsically conducive to high FCF generation due to its low capital intensity. Capital expenditures, CapEx, requirements are minimal and stable, ranging from $0.76 billion in 2020 to $0.60 billion in 2023. This persistent low-maintenance CapEx ensures that the vast majority of operating cash flow cascades directly into FCF.
The FCF before dividends trend mirrors the strength of the CFO, rising steadily from $7.16 billion in 2020 to peak at $8.81 billion in 2023. In 2024, FCF moderated slightly but remained substantial at $7.901 billion. This consistent multi-billion-pound FCF base provides the necessary resources to fund both the progressive dividend and the accelerating investment required for the NGP transformation. Recent data from the middle of 2025 indicated a cash from operating activities of $9.27 billion and a reported free cash flow of only $1.91 billion. A sharp annualized drop in FCF of this magnitude requires careful interpretation and contextualization by the analyst. Tobacco sector cash flows are inherently seasonal, typically exhibiting a strong weighting toward the second half of the fiscal year. Therefore, comparing mid-year results to the prior full year can be misleading. Furthermore, the reported dip in FCF is consistent with management's stated strategy of elevated investment required for NGP expansion, alongside potential timing differences in working capital, tax payments, or currency effects. Consequently, investors should prioritize the confirmed stability of the long-term trend, 2020-2024 consistency, over short-term fluctuations, particularly since management has already characterized the current period as an investment phase. Balance sheet solvency and capital structure management. BAT's success in managing its balance sheet is critical to mitigating the high risk perception associated with the global regulatory environment. 8. The analysis confirms a successful and proactive approach to deleveraging and debt management. Leverage profile and deleveraging commitment. The post-acquisition leverage profile has been a consistent focus of management, resulting in the successful achievement of key financial targets by year-end 2024. In 2024, BAT reached an adjusted net debt to adjusted EBITDA ratio of 2.44x. 3. This result is significant as it brings the company within the long-stated target corridor of 2.0 to 2.5x, demonstrating the company's commitment to financial prudence over potentially aggressive debt-fueled capital deployment. The closing net debt figure as of December 31, 2024 was $31.253 million, stemming from total borrowings, including lease liabilities, of $36.950 million. While this total debt burden remains substantial, the high magnitude and exceptional stability of the underlying annual cash flows, $10.13 billion CFO in 2024, confirms its manageability. Debt maturity structure and interest rate risk mitigation. The composition of BAT's debt portfolio is structured defensively to prioritize long-term stability and minimize financing risk. The company boasts an extremely long-term debt horizon, with the average centrally managed debt maturity close to 10 years. This timeline substantially exceeds the group's minimum internal target of at least 5 years, effectively pushing out and mitigating near-term refinancing risk. Further reinforcing the financial defense is the high proportion of fixed-rate debt, which accounts for 78% of the portfolio. This commitment to fixing interest rates on nearly 4/5 of the outstanding borrowings is a crucial financial decision. Given the sustained global environment of elevated interest rates, this proactive management insulates the profit and loss statement from rising interest expenses, which is critical for safeguarding net income. Protecting net income, in turn, provides an extra layer of structural protection for the earnings-based dividend coverage ratio. Short-term debt remains minimal relative to liquidity, with net debt due within 1 year reported at $1.573 billion in the 2025 interim announcement. Moreover, the group maintains strong liquidity, highlighted by access to a $5.38 billion revolving credit facility, further demonstrating preparedness for any tactical refinancing or unforeseen liquidity requirements. Causal relationship, strategic deleveraging, and litigation outflows. The successful deleveraging program has created essential financial flexibility, which is necessary for absorbing large non-operational cash demands. 8. The largest near-term liability is the expected $2.6 billion upfront payment scheduled for the second half of 2025 to finalize the Canadian litigation settlement. This anticipated outflow, while significant, has been strategically mitigated. The successful partial divestment of BAT's stake in ITC yielded $1.577 billion in cash proceeds in 2024. This strategic sale of a non-core asset serves as a pre-funding mechanism for the $2.6 billion litigation charge, substantially reducing the reliance on core FCF or new borrowings. This proactive management confirms that the material non-recurring litigation payment will not substantially reverse the positive hard-won deleveraging trajectory. Assessing dividend safety and payout sustainability. The dividend payout is the cornerstone of BAT's investment case, and its safety is underpinned by a clearly defined, sustained policy backed by highly reliable cash flow generation, even when facing major non-cash impairment charges. A. Dividend policy and coverage. BAT's dedication to returning capital to shareholders is deeply rooted, evidenced by its record of continuous dividend growth over decades. 14. The core policy is to maintain a progressive dividend, ensuring the payout grows each year. This policy is specifically governed by a mandate to achieve a 65% payout ratio calculated based on long-term sustainable earnings.
For 2024, the dividend per share reached 240.24 pence, representing a plus 2.0% growth rate over the prior year. 4. The actual earnings payout ratio for 2024 was 66.3%. 4. While slightly above the 65% target, this ratio remains conservative within the context of the sector and is well within the management's historical operating range. A vital analytical distinction is the use of sustainable earnings rather than reported statutory figures for the policy calculation. In 2024, BAT recognized substantial non-cash impairment charges related to its U.S. operations, which severely depressed its reported diluted earnings per share to 136.0 pence. By basing the dividend on adjusted, sustainable earnings, management structurally insulates the dividend's integrity and growth trajectory from highly volatile, non-cash accounting charges. This reinforces investor confidence in the long-term safety of the payout, providing necessary protection during periods of financial restructuring or accounting volatility. B. Cash flow coverage margin analysis. The primary determinant of dividend safety is coverage by free cash flow, FCF, a metric BAT consistently exceeds. While the precise FCF payout ratio is not explicitly published, the capacity for coverage is unambiguous. 2024 FCF before dividends was £7.901 billion. 4. Total annual cash returns encompassing dividends and the sustainable share buyback, $698 million in 2024, are amply supported by this massive cash generation capacity. The company's ability to withstand significant financial shock is demonstrated by its FCF surplus, even when anticipating major liabilities. The anticipated $2.6 billion Canadian litigation payment in the second half of 2025, too, represents approximately one-third of a single year's FCF. Considering the projected annual FCF, the remaining approximately $5.3 billion in cash flow, augmented by the $1.577 billion from the ITC asset sale, easily covers the annual dividend obligation and essential maintenance capex. This comfortable margin of safety is critical, providing assurance that the dividend is structurally protected and not jeopardized by temporary material liabilities. The resulting income profile for shareholders is highly attractive, with the forward dividend yield estimated at 5.68%. While this yield is below the historically observed median yield of 7.72%, the current high yield compensates investors for the inherent social and regulatory risk premium embedded in the sector, making BAT a robust income security for defensive, yield-focused portfolios. Valuation context, sector discount, and NGP transition. BAT's current valuation reflects a deep and persistent market discount relative to its major peers, a situation that represents a significant value opportunity contingent upon the successful, profitable execution of its NGP strategy and a reduction in regulatory uncertainty. The strategic transformation imperative. The market's assessment of BAT's long-term viability, and thus its valuation, is fundamentally tied to its ability to transition away from its combustible reliance toward NGP categories. In 2024, the company made demonstrable progress, adding 3.6 million adult consumers to reach a total of 29 million consumers of its smokeless products. 9. Financially, the NGP portfolio critically contributed 17.5% of group revenue in 2024, marking a solid 1.0 percentage point increase over the 2023 financial year. 9. This ongoing progress keeps BAT on track toward its long-term targets of achieving 50 million smokeless consumers by 2030 and 50% of group revenues from smokeless products by 2035. Crucially, management has shifted its focus toward quality growth, which involves targeting superior returns on investments and accelerating profitability within the new categories, particularly the high-growth modern oral segment. This strategic pivot from mere volume acquisition toward profitable expansion is an essential precursor for achieving the elevated enterprise value multiples enjoyed by sector leaders. It demonstrates a viable, structured path towards sustainable NGP profitability, directly addressing a core investor concern regarding transition execution risk. Persistent regulatory headwinds and valuation pressure. The chronic and intensifying regulatory environment imposes a structural, long-term weight on BAT's valuation that overrides its robust underlying cash flow fundamentals. Key external risks cited in the company's disclosures include adverse domestic or international legislation and regulation, significant increases in nicotine-related taxes, and adverse litigation outcomes. 8. The entire tobacco sector carries the highest social risk within the branded consumer products sphere, due to the well-documented health effects of smoking, which contributes to heightened pressure from ESG considerations and limits the available investor base. The ongoing litigation exposure, as exemplified by the requirement to address the $2.6 billion Canadian payment and continued class action filings in key jurisdictions, necessitates the embedding of a litigation risk premium in the valuation. Further complicating investor perception is BAT's significant and challenging footprint in the U.S. combustible and vapor market. Successfully navigating the constantly evolving U.S. regulatory landscape is critical to global success, and perceived execution risk here contributes significantly to the persistent valuation discount. Current valuation, historical context, and peer benchmarking. A detailed analytical comparison of key valuation multiples provides quantitative evidence of the deep discount applied to BAT's equity, confirming a value opportunity. Historical valuation trajectory.
The movement in the enterprise value to EBITDA, EV by EBITDA, over the last 5 years offers crucial context for the current share price level. This multiple measures the value of the entire company relative to its gross operational earnings power. From fiscal years 2020 through 2024, BAT's EV by EBITDA averaged 8.3x and maintained a median value of 8.8x. The ratio was recorded at 8.8 in both 2020 and 2021, reached a 5-year peak of 9.6x in 2022, and subsequently hit its 5-year low of 6.3x in 2023. The latest 12 months LTM EV by EBITDA is reported at 9.6x. The current 9.6x LTM multiple represents a significant re-rating and recovery from the deep pessimism experienced in 2023, when the multiple compressed to 6.3x. That valuation floor likely reflected peak investor fear regarding the combination of debt leverage concerns and perceived NGP transition uncertainty following the U.S. impairment charge. The subsequent recovery back toward the historical median, 8.8x, and peak, 9.6x, confirms that the market is beginning to recognize the tangible success of management's deleveraging program and the stabilization of core cash flows. B. Comparative sector benchmarking. The comparison between BAT and its closest multinational peer, Philip Morris International, PMI, reveals the extent of the undervaluation driven by strategic and regulatory differentiation. BAT's LTM EV by EBITDA of 9.6x, 5, trades at a massive discount compared to PMI, whose LTM EV by EBITDA stands at 15.9x. This nearly 40% valuation gap is fundamentally difficult to justify based solely on the operating stability and quality of BAT's cash flow engine. This discrepancy arises primarily from strategic differentiation and regional exposure. PMI benefits from its ex-US focus and the advanced profitable deployment of its leading heated tobacco category, IQOS. Conversely, BAT's lower multiple is a function of its ongoing U.S. exposure, where litigation and regulatory risks are considered acutely higher, and its diversified, multi-category NGP approach, Vuse, Glo, Velo, is perceived by the market as carrying greater execution risk than PMI's near-monopoly heated tobacco strategy. Therefore, the current discount explicitly prices in this high perception of regulatory and execution uncertainty. Given the highly stable and low capex FCF generation, nearly $8 billion annually, the resulting implied price to FCF multiple for BAT must be exceptionally attractive compared to its peers. Since the market heavily relies on FCF multiples for valuing tobacco stocks, which are fundamentally income generators, benchmarking this robust FCF generation against the currently depressed stock price strongly suggests that the equity is trading significantly below its intrinsic value, based on fundamental cash-generating capacity. 7. Concluding investment recommendation. The investment case for British American Tobacco is affirmed as a robust, high-yield opportunity. The company offers predictable and secured cash returns backed by a strong foundation of operating performance, providing a compelling total return profile supported by a long-term catalyst for capital appreciation. The financial foundation. BAT's core financial architecture is characterized by its high cash conversion, 101% in 2024, 3, and a deeply entrenched stable multi-billion-pound FCF base, $7.901 billion in 2024, 4. This structural strength provides a durable foundation for maintaining and growing its progressive dividend policy, 65% payout target. Furthermore, the balance sheet has been substantially de-risked by successfully achieving its deleveraging target, 2.44x, 3, and implementing a protective debt structure, long maturity, 78% fixed rates. Even when accounting for the material, non-recurring $2.6 billion litigation payment in 2025, FCF coverage remains secure, assuring the safety of the dividend. The valuation opportunity. The equity trades at a critical and unwarranted discount, reflected by its 9.6x LTM EV by EBITDA multiple, 5, compared to the 15.9 multiple of its primary peer, 6. This discount is purely a function of non-operational risks, specifically regulatory uncertainty, litigation exposure, and lingering perceived NGP execution risk. 7. The catalyst for re-rating. The primary catalyst for convergence in valuation and subsequent capital appreciation remains the sustained, successful delivery of the NGP transition plan. Continued and disciplined growth in smokeless revenue contribution, 17.5% in 2024, and consumer count, 29.1 million, 9, particularly if coupled with the demonstrated achievement of targeted profitability within these new categories, should systematically erode the perceived execution risk priced into the equity. The resulting normalization of BAT's valuation multiples towards sector averages would unlock significant capital appreciation, thereby complementing the high, secure dividend yield currently offered. The investment recommendation is predicated on the view that the underlying financial strength provides ample protection while the strategic transformation matures.